Hey, everybody. Good afternoon. This is Doc Severson, and I've got Dave Lukas here of 12minutetrading.com. Today's Monday, the 6th of March, right? 6th of March. And we're,
Amazingly that fast.
yeah, no kidding. And it's like we've got another week filled with landmines. It's just amazing. It seems like every single one. So we've got Powell talking twice in front of Congress this week, Senate tomorrow, and I think it's the House subcommittee on Wednesday, and then we've got various reports on Thursday, like jobless claims, and then we've got big jobs report on Friday. So here we go again. The market is just so unstable. We've seen just a blast off, 150 plus points off the bottom from Thursday morning. The market literally peered over the edge into the abyss, because if it did lose that level at 39.25, it was going to be a straight drop down into Hades for this market, but it was able to. Thank you for Raphael Bostic. So Fed speak not only pushed this thing down a couple hundred points from James Bullard a few weeks ago, but now Raphael Bostic pushed it right back up again when he said, I'm firmly in the 25 basis point camp. So nobody can figure out what's going on. We've got a market which is being tossed and turned asunder by the Fed, and we get more of it this week. What do you think the jobs report's going to come in at, Dave?
I don't have a clue. Based on like January being at up 500,000 plus jobs, double plus, more than double expectations. I wouldn't be surprised to see a big revision for February, but I think it's important what you just said, because the markets and the Fed speak is one big portion of this, but we were talking about this over the weekend. We were going back and forth with our mastermind group and just chatting away through our private channel. And we were talking about the fact that zero DTEs kind of changed the game for markets, right? So that's why you see like Bullard on a Thursday has one comment. He's not even a voting member. And all of a sudden the market tanks 200 points. Why? Because you've got all these zero DTE traders that were positioned to go higher. He comes out, selling starts, and they got a cover, and it just exacerbates that move. Right. And then same thing with Bostic. Thursday afternoon, he comes out and he says, hey, I think we can end by summer, and I'm 25 basis points, and everybody was positioned to the downside. And guess what? He says that you get some buying come in, and all of a sudden everybody's got to cover back the other way. So I think the new, and I think we talked about this last week, there's been now like almost 25 days of 1% or better moves in this market for the year. That's like a whole month so far. It's like half the days of every month are over 1%. That's all due to zero DTE. Over $1 trillion a day is being traded on zero DTE. Now the markets are huge, right? They're tens of trillions of dollars, but 1 trillion worth of trading on zero DTE moves markets, and that's why we get these intraday swings. Like look at today where we're at right now. We started the day with the S&P 500 shooting up 34, 35 points. Now we're up 5 or 6, I think, right before we started this, right? So like that's that zero DTE intraday trading, because people have got to make their moves and be out by 4 p.m. today. Otherwise they lose. And that's, I think, the new normal of what we're going to contend with in markets. I heard that we're actually talking, some of the exchanges are actually talking about doing half day expirations. So not only 4 o'clock, now we got like a noon expiration coming in, right? So it's a brave new world in trading when it comes down to this stuff now. And we just have to be ready for that. It's be okay with that volatility. It's intraday.
Funny because 11 years ago, I was playing around with something called binary options. Have you ever experimented with those? Well, it's essentially it's the same thing. They're printed. I don't know if they're even still exist. It was through Nadex.
I don't think they exist. Yeah,
it's through Nadex.com. I'll have to look and see if they're still alive. But I was trading these things, and they only last for 2 hours at a time, or you can pick end of day. But back then, that was a zero DTE option, and you were basically betting as to whether or not it was going to end up in the money or out of the money by the end of your time period. And it was insane. The spreads were
Yeah.
huge and wide, and the commissions were hefty, and it was really, it was not sustainable. It was not something that I could get working back then, just because of the costs were so high. But that's where I see things going. I mean, eventually, I mean, if you look at the continuum, when
Every
you and I
hour.
started this 20 years ago, all we had were monthly expirations, and we had those silly, expirations they'd stop trading on Thursday and they'd settle Friday morning, the AM settled stuff.
Mhm.
And then we got, weekly options, Friday. And that started, I think, around 2005. And that was a big
Yeah.
thing. That was a big deal,
Yeah.
But since then, we've gone full zero DTE as of last year. So this is not something
look
new.
at,
This
look
has
at that
been,
progression, because we went to like 3 days a week
yeah,
right before that, the year before, and then all of a sudden you're zero DTE. Like, it's moving so much faster into, you may get to where you have hourly expiring options.
yeah. I would not be surprised if there is a market for that. They'll try it somewhere, these exchanges, because now everything is run. I mean, they don't really need people to run these things. So you'll have
Yeah.
exchange, basically run by itself, and you just don't need people. So why not? If there's something that
Well,
they
and
can
the
sell, they'll
brokers
do
love
it.
it because they're going to make a ton of money off of it.
Right.
Because most of these are going to expire worthless anyway, so they're just printing cash for themselves off of it, which is why it's happening. Plus, and I say this a lot, in like my podcasts and other things. I've said it for years, is that we've moved to where we live in this instant society. Like, everything's got to be now, 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 now. Which is why we need options to trade same day, because people can't stay in for a week anymore. That's like too long, right? We stopped the microwave with 3 seconds left. We can't even wait 3 seconds anymore. Like, that's the world we live in, and it keeps getting worse and worse, right? So that's what I'm saying. This is the new normal that you have to be ready for. So, and the ironic thing is, you and I were talking about this earlier, is that a lot of like the expected moves that you see, like for like whether it's 2 days out, 5 days out, 1 day out, that sort of thing, it's amazing how those do hold true, right? So let's say today, I think the expected move for the SPX for Friday was like 78 points or something for Friday, meaning that plus or minus 78 points is where the SPX is expected to be after, from its open price today, right? Well, we may get there. In fact, we probably will end up in somewhere around that plus or minus. We may go on a 200 to 300 point round trip to get there, though. We may go up 250 points and come down to end up 78 points. Like, that's something you have to be ready and used to and have the stomach for nowadays in what we have in this trading world that we've moved into, this new kind of paradigm of options trading. So look at today. Yeah, look at that.
While you mentioned that, I mean, just to decode this for you folks that are out there, the red zone here, this is called the opening range. That's the first 30 minutes of price action. And then the yellow areas just carried forward to that point. So there's a downside gap that we had this morning, and the market ran away from that downside gap. Now, this blue line up here is the expected move, the positive expected move for the day. Notice how the price came up 1, 2,
touched it,
3, and then rejection. That's called mean reversion. So there was a big time mean reversion move early on this afternoon. Now we have a negative expected move. Wouldn't that be interesting to see if we go all the way from one end of the expected move to the other by the end of the day? This trend does not look good. And also, we don't have the market internals. Let me bring those up. Let's see what those are doing. They are heading.
Well, I wouldn't
downward.
be surprised, since Powell's speaking tomorrow, right? Who wants to hold risk into that if you don't have to?
Yeah, certainly you'll be able to open up the market without, but who knows what he's going to do? I mean, usually they have an opening statement, which is sent off to the press. So at 10 o'clock, there's an initial burst of volatility based on the opening statement. And then, we get to the actual back and forth. And I remember the first few times that Bernanke did this, and he was just an open book, and it was like the market was not ready for that. And I remember seeing like Bernanke testimony, and you'd have that little red Dow ticker down there, negative 200, negative 300, negative 4. And it was, but now, Powell's generally pretty good with this stuff. He doesn't really say anything. He's very, very transparent with this stuff. really the problems that we've had has been more around the Fed speak, where all these other trained monkeys are out there yabbering away on or something that is not the party line. Like, well, I think it should have been a 50 basis point rate hike. And, thank you, James Ballard. You're a non-voter. We don't care what you think.
Yeah.
So,
yeah. And so that coupled with, you got algos trading, right? So you got algorithms trading, you've got technical analysis lines to program to, like a perfect, what you just saw was the setup where it hit the expected move and, 3 times and then has dropped back down. But that is most likely due to algo selling. But what that does, as soon as that starts to happen, then by this time of the day, all these zero DTE guys that were positioned for things to go higher, and it's not happening for them, they got to cover and they got to get out now. And
right.
So that exacerbates the drop down lower, right? So, and then we might have some buying come at the end of the day and push it back up for some people taking advantage of the move down. So it's just going to be intraday is going to be a lot more volatile than things used to be. And that's just the new normal of that you have to get used to. And a lot of days we may go nowhere. We just may go up and down like that all day. Big swings, maybe 1%, but we ultimately go nowhere, right? So that's just the type of thing you have to be prepared for.
I may dust off my futures account if it's going to keep doing this.
You should pull up the 3 fractal charts that we typically look at, because I think that's interesting too right now in the context of all of this. We have bigger movement and momentum that is on tap to take place. And I think, looking at that is important for us to keep context from these intraday things, because we still have the daily, the weekly, and the monthly charts that are, in their positions, right? So look at the monthly chart. I was seeing that today. The monthly chart's going up even higher, from where it was. It was already fully charged. And now it's after last month heading higher.
It's incredible. So, if you look at the last time that we had anything near this high was back in what is that, late 18. So we got a little snapshot move, and then boom, and then that really set up the pandemic move. So
look at that. Look at that trend. And that's the thing. How far did that go? Right? That went from where?
That went from 3,000
2,400-ish to 3,200-ish. Is that right?
Oh, it doubled. It went from 24 to 48. If you include all of 21. So it doubled.
If you look at all of it as the move. So that's the type of move that a monthly swing can give you guys. Once this thing decides to go, you're looking at the next year trend.
Yeah.
And the fact that it's spiking higher, oh my gosh, it's just the trend's going to be massive that comes out of this. And look how it keeps getting, you've kind of got that triangle pattern formed there. And it's a sideways triangle. And those are the worst because you don't know which way it's going to break. So it's like toying with us now.
To some degree, that's like an ascending triangle because you're seeing a series of higher lows.
That's true.
And, for the most part, equal highs. 4,100, 4,200 has been difficult to get. But we keep seeing these higher lows. And so every time we dip, we end up printing a higher low. Now, there's one thing. I may have brought this up last week, but I think it's worth bringing up again. And I'm not a big fan of bringing up, well, this happened in the past, so therefore this is going to happen again. But I guess the reason why I want to bring this up is to say that we've seen this movie before. Okay, so here was back in 2011, we had that horrible news that Standard & Poor's has decided to downgrade the United States. So instant boom. We just dropped like a stone for a couple of days, and it was a terrible weekend. And then it took a long time for this thing to double bottom, undercut. And so what we saw was a short covering rally up until a beautiful pennant consolidation. So everybody, and this is just like what we saw in the equity markets at the beginning of February, where we had that wonderful January rally. It was rocking and rolling. And all of a sudden, all the long portfolios were turning green again. It was great. We haven't seen this for a year. And so we got up to this consolidation in early February, and people were like, hey, that's a bull flag. That's a bull flag. What happened? James Ballard, all the way down to the 61.8% retracement, just like this one did. So this one got right down to the edge, peered over into the abyss. You got to remember, this was only a couple of years after the very, very bottom of the great financial crisis. So people are looking, like, oh no, like this thing is heading lower. We're going to retest the lows again. And so it freaked people out. And right when we looked over the edge, this thing ripped higher for about 3-4 days. This is where retail got long. Retail got long right there. And what do you think happened? It shucked them off one more time. It went all the way down to the 61.8% retracement of that move. Now, if you take a bigger picture look at this thing, it's just a great big triangle. But this is how money moves to shuck retail off. Like every time the move is obvious to retail, it will find a way to ditch them off. And so what happens is when the eventual rally comes from this, talk about disbelief, there is nobody on board. There's nobody on board for those rallies when they finally hit, right? Because it's like, hey, I'm not going to do this because I've just taken 2 big losers in a row, and I'm going to wait until this thing settles down, right? How many times have we felt like that?
And that is a great time to remind people of the 4 phases of the market, right?
Yeah.
Disgust, disbelief, acceptance, euphoria. And so we certainly could see Powell do that last move that you just showed there. I personally think Powell will be somewhat hawkish in front of Congress tomorrow. First brand new Congress, first time with them. I don't think he's going to be, overly optimistic. I think he's going to be measured and maybe a little bit more hawkish and say, we're going to do what we need to do to get inflation in check, right? He's going to come off that way, especially with the House on Wednesday. So I think, we could easily see the market go down over the next few days, and then that rally that you're talking about kick in from the weekly chart and maybe the monthly chart. It might be a little early on that yet, but gosh, that thing can go any day. That thing could happen at any time.
So we're calling it right now. We're calling it right now in the room. We're going to have a J Powell
move.
J Powell pullback here over the next couple of days. And jobs are basically let me bring this up too. Let's see, where have we got?
Well, you have jolts on Wednesday too, and that's been a market mover as well. So,
but nothing,
we'll see what the openings look
nothing like this guy, especially with the 517, with a number that nobody knew what to do with on the 517. So now they're sandbagging. They're setting up such a low target of consensus 215 with a relatively benign range, and this one will be easy to hit and easy to exceed, but we'll see what happens. A lot of people are talking about the January numbers being due to seasonality and everything like that. So we'll see if this truly does come down.
One thing that it does hold, if you go back over the last several years, you look at January's numbers, they are higher. In fact, I think the January before we were almost 500,000. So that is true that seasonality plays into it. So again, I think the big thing with this one won't be so. We'll see what the number is for February, but the bigger, I think, the people will be watching here is what's the revision for January.
Oh yeah,
I think that'll be the bigger one.
Yeah, that's a good point. Yeah, I think that's going to be. So yeah, maybe it's going to come down from 517. We had some of the numbers that we've had from the CPI and stuff like that. They revised them higher, which has been a little unsettling. And that's a reason why we went down in February a little bit.
Yeah, and they've continued that. I don't know if you saw even some of the numbers recently that they've revised higher and stuff. I mean, and the revisions were really large revisions. We're talking like 3-4 tenths of a point revisions back upward, from where they were. But that's the thing. The revisions don't carry the weight that the initial announcement does in the markets, right? They're not traded like the like that is. It just at least that's how it seems out there, because the markets haven't moved off of those like they should. So that's where we stand. This week's a volatile week. I think you and I both were like, hey, short-term trades like the Target 100 strategy, we're going to take a break off those, let J Powell do his thing. And then I'm trading on Wednesday after Powell does his thing. I think jobs will have some market movement, but I think a lot of that is fairly priced in. Again, the revision will be what it is for January, but I think Powell's really going to make the moves, and then I'll be doing my trades on Wednesday afternoon, probably after he's done, and see where the market settles into. But other than that, I mean,
I'm gonna go ahead and do it on Tuesday, because I have never seen day 2 on the Fed chairman is a total snoozer. There's nothing new that comes out the second day that they talk.
I thought about that, but remember, the Senate is more of a known commodity because it hasn't changed control, but the House has, and this will be his first testimonial with them. So it's not so much him; it's the people asking him questions that where the fireworks can come from. If somebody asks him something out of the blue that he hasn't had to answer yet because it's a brand new Congress that he hasn't been in front of, like the Senate, he is a known commodity and it's controlled by the same party that had him in last time, right?
Yeah.
So I thought about that too, but I'm kind of like, what's a day for me trading like, my double strategy or my long-term strategy or something like that, right?
Yeah.
Let it see if it settles in. But definitely from a target 100 standpoint, you could, because you'll get the initial move off of Tuesday. He'll come with the same remarks on Wednesday, prepared to say the same things. It's just to somebody throw him off his game with the way they question him or something like that.
Yeah, no doubt. So I'm thinking that, just being a contrarian, right now, we've only got 75 basis points priced into the end of the year for rate hikes, including the one coming up in a couple of weeks. So that's going to be probably a quarter point, but we'll see. I don't think
Bostic is right. It probably will end by the summer. He's just confirming what the markets pretty much have priced in. But the bigger thing with that is it's even though that's what's priced in, it's the fact that they are predicting them they'll stay there longer is a bigger thing than it used to be. It used to be that we're going to get some rate cuts in the back half of the year. Now that's not being priced in at all, right?
They now have Fed funds futures going all the way out to the back half of 2024. If you want to see something really crazy and speculative, look at what rates are going to be, in a year and a half from now. So I'm
all you gamblers out there.
Yeah, I'm looking for the market to throw everybody a curveball into the end of the year, and to me, that curveball would be an unbelievable rally that nobody is on board for.
Yep, I agree.
That's what I'm thinking. I'm always trying to like what would have to happen to throw the greatest chaos into the market, and it would be a rally at this point because everybody's bearish. I mean, it's like I listened to Maria in the morning, and just about all the guests are on there. Well, we know that there's going to be a bad recession.
Bad recession. Yeah.
And it's like
the
market already knows that.
What I don't want to see, you don't want to see it like January was a heck of a move to get it going if that's the case, but you do not want to see it keep going like that because it will crash. It's got to grind higher. And if it does that, people are just left and right going to doubt that thing. They're going to just, there's no way, and it'll just keep grinding and grinding. But that's the most sustainable way to do it. If it just goes parabolic, if we go up another 10% in March into May, that thing's just going to come crashing back down just as hard.
Yeah,
so
corrections are always a reflection of what the price did to get it to that point. So the higher it goes, the stronger it has to pull back. And the more measured that it goes, it can almost do that in perpetuity.
Yep, exactly. And that's what we want. That's a great trader's market, especially for our strategies and stuff. It's awesome. Yeah,
so absolutely.
Cool.
Well, Dave, thanks for carving some time out for the folks out there. We want to thank you guys for joining us live, as well as those of you that are watching this on a replay. We do this once a week. So please reach out to us and let us know if there's something that you want us to cover in these. We'll be happy to do that. We love interactions with people. We love to see some comments and some questions coming in while we do this. So this is a participation sport, right? So anyway, well, that's it for this week here at 12-Minute Trading. Again, I'm Doc Severson. We got Dave Lukas over here signing out. And
thanks, everybody.
Saying we'll see you guys next week. Take care, folks. Bye now. All right.